need to unmute.
Carl?
Thank you very much. Oliver, do you hear me?
Yeah. Yeah, I hear.
Okay, we have to mute one of the cameras.
Yeah.
I will.
So, I'm sitting here with Sandip, Bhagat, and we had you before. Thank you very much for now joining us at our hub live. And we would like to have a fireside chat with you, and thank you very much for agreeing.
It's great to be here. Thanks for having me join you.
Thank you. So let's start. And I am sorry that I asked you to reintroduce you and your company and everything, because the videos are at the end cut. So we need it.
No worries at all. For those of you who haven't met me or know me, I'm Chief Investment Officer at Whittier Trust. Whittier Trust is a multi-family office. In fact, it is the oldest and largest privately held multi-office here in the western part of the United States. We manage about $20 billion for about 500 different families. My career, Carl, has focused just on wealth management, investment management. It is now in its 4th decade. My prior firms have been Citigroup, Morgan Stanley, and Vanguard. And I am, as I said before, delighted to join you for a conversation.
Thank you very much. So this conversation, let's start just to speak about risk. You are a wealth management firm, so this is one of your biggest concern, am I right?
Absolutely. And Carl, the last 2 years have been so unprecedented. I know that word is used loosely, probably overused, maybe even abused, but really it is hard to imagine what we have seen in the last 2 years. And without that perspective on risk management, on building diversified portfolios to begin with that could absorb all of these pressures in turbulent market conditions, starting with from that vantage point, to then continuing on and avoiding what would have been really expensive mistakes. Imagine panicking and selling out at the end of March 2020. Right? Markets had declined by about 35%, and that would have been selling at the low. So we had to draw on every ounce of judgment, skill, experience to navigate these turbulent times. And I'm happy to report that we got most of the things right.
I just want to make a disclaimer here. This video is informational only. None of us, not Mr. Bhagat, sorry, my tongue was
it's not an easy word.
Sandip Bhagat, not me, give any financial advice here. We're speaking just about our personal opinions and about risk in this time after COVID or right now with COVID. So COVID changed, how you say it already, to safeguard your investments from the firms. What do you see is the biggest risk which we face right now after 2 years in the pandemic?
Carl, I'll give you a short answer and then I'll give you some background on how these risks have evolved. So as we speak right now on the 18th of January, without any doubt, inflation is the single biggest investment risk. Now, how did we get here? Why is inflation such a question mark? And was that the #1 risk factor all along? I don't think so. Just let's roll the clock back a couple of years, right? The virus comes out completely out of the blue. At that time, this is what we knew about medical science and innovation and history in this field. No vaccine had ever been developed in less than 3 years. And here was a genetic map of a virus that the world had never seen before. So the future was supremely uncertain, and the virus, by and large, by and far, was the biggest risk out there. And then human ingenuity, medical innovation came through in spades. We developed not one, but several vaccines. We were able to roll them out quite easily. And so that risk has been conquered. And then what happened along the way was, because the pandemic created the it turned out to be the shortest. We put together a lot of stimulus by way of policy responses. So it is the central bank's job to control interest rates. They also engage in something called quantitative easing, which is the purchase of bond assets in order to lower interest rates. Central banks engaged in a lot of government spending. That stimulus was so massive that what it has led to today is a very strong economic recovery. And because supply chains have been disrupted by the pandemic, that combination of supply side constraints and strong demand has given rise to high inflation.
It's clear. This is a really good point. When we start spending government money, basically, you print money, inflation follows. We all learned in our textbooks that this inflation will hit 10 years later. We saw it by examples in Europe, reunification, afterwards inflation, and it was always a time delay. So the time delay which we have via digital, more connected information changes. Our life just became a faster pace. Do you think the inflation risk, which is there, but that we see the hyperinflation will come, or not a hyperinflation, or a really big inflation? Sorry for the wrong word, hyperinflation. It has a definition. I apologize to the audience. How do you see the progress of the inflation over the next 10 years?
Okay, so Carl, I'm going to make an observation. Much like a very good politician, in one question, you managed to bundle 3, 4, or 5 different questions.
My lawyer would say, sorry, combined question, objection.
No, I'm happy to answer all of them. So the reason why inflation spiked up at the speed at which it did is that the dislocation in the first place was so severe, right? The pandemic just hit us like a ton of bricks. Entire sectors and industries shut down overnight. Their revenues went to zero. So that led to labor shortages, and supply chains that had been put in place got completely disrupted, and you can't turn them on very quickly. So that's in the past. That's what explains why inflation spiked up so much. Allow me, before I answer your question about what lies ahead, to just put some numbers to how big the problem is right now. So I have a US-centric focus. We're sitting here in Los Angeles. Inflation in the United States typically gets measured by the Consumer Price Index. The headline inflation number based on that metric hit 7% in December. The 12-month year-over-year change was 7%. How remarkable is this, or how unusual is it? It's a number that hasn't been seen since 1982. There is a Producer Price Index. The main headline number for that, inflation hit 9.7%. So it's really high. Now the question is, Carl, what lies ahead? So if you just sit back naively, there are 3 possibilities, and I will lay them out and I will handicap those for you and for the audience. 1, this trend continues and we go a lot higher. This would result in your hyperinflation possibility. And by the way, we saw it in the United States in the 1970s. Inflation was 10%, 12%, 13%. So double-digit runaway hyperinflation, out of control inflation. That's a possibility. Will it happen? I'll have an answer for you in a minute. The second possibility is maybe it doesn't get so bad. Maybe it gets a little worse. Maybe it peaks soon, and maybe then it subsides. And then the related question, the third possibility is, should it begin to subside, will it drop as quickly as it went up? Will it come down to 3% very quickly? Or will it come down gradually? So I framed the questions, but the audience wants answers. So here we go. That first possibility, the hyperinflation you spoke about, I don't think, we don't think, my team doesn't think that's a very high risk. Let's draw a parallel. In the 1970s, we saw that level of inflation because there was a supply side shock in the oil markets. The oil markets got disrupted. There is no risk of that happening this time around, not in the oil market or with any other commodity. If anything, oil producing nations had to cut back on production. They're more than happy to increase it. So supply in oil is not a major threat. Number two, will it peak soon, or are we looking at 3 more years of this pain with 7, 8, or 9% inflation? I think it's going to peak soon. And the reason for my optimism is as follows. Last year in 2021, this is when inflation began to rise. Why did it rise so quickly? One of the things going on behind the scenes was when the pandemic hit in 2020, it immediately lowered prices of a lot of goods because demand simply evaporated. Now, prices were so low in 2020 that a year later, it was quite easy for them to bounce back up. They were artificially low, so the measurements were high. In 21, they have already become high. So when we go through 2022, in the coming months, it'll be harder for prices to go a whole lot higher from already high levels. So that's just one of the reasons why we think this recent pace probably is not sustainable. So that's good news. But unlike the consensus, everybody expects that inflation will come down towards 3% this year and towards 2% next year. We think that is too optimistic. I disagree with that overly benign view. I think inflation will come down, but slower than the speed at which it went. So there you go. There were a number of possibilities. We described them, and I'm giving you my best thinking, but what might happen.
I would like to drill down again in the inflation. So we know that increased government spending causes inflation. We laid out the inflation which we had because of the broken supply chains. So we have 2 different waves of inflation. One, the broken supply chain, when I understand you correct, but one, which is the delayed one, which historically always hits 3-4 years afterwards. This is when you spend money enormously till it goes through all the channels and the prices rise. Do you have a time when the spending inflation would hit, and how big you will see the spending inflation will hit? Because, or do you think it's all immediately in? Basically, do we have a perfect pricing model as a pricing model, and as information is already in? Or
that they have captured it?
yeah,
This is about as bad as it gets. So, you know, my eyes wandered. I see blue skies, the sun is shining. I feel good, so I'm going to give you an optimistic answer to this. And I know this is in the minority view because people worry about the size of debt that we have underwritten. Let's understand the scope. Debt to GDP ratios in the United States are now right around 100%. And they have gone up after the global financial crisis, where we did some of this activity. We printed money. The Fed increased its balance sheet, government spending went up. Debt to GDP ratios had gone up to 80% or so. And the worst fears were, given this high level of debt, the dollar would become unattractive. The US would essentially not just devalue its currency, it would actually go outright and debase its currency. That hasn't happened. Money supply has gone up. It did go up after the global financial crisis, but we saw no inflation for 10 or 12 years. And this is despite the fact that all that stimulus never really ignited the economy back then. We had the longest expansion for 10 or 12 years, but it was with really sluggish, anemic growth that barely reached 2% real GDP growth. So I'm going to turn this around and give our audience something else to think about. There is a real chance that the stimulus this time around is actually going to work. It's going to make its way into the system and jumpstart the economy. We have some evidence to that. In 2021, the economy grew at a real growth rate. Real simply means it's nominal minus inflation at over 5.5%. This is way above the 2% that we had seen for the previous 12 years. In fact, because inflation was on the high side, nominal GDP growth, which combines the two, was more than 10%. These are rates of growth that have not been seen in a long time, for 5, 10, 15, or 20 years. And the reason I bring this to mention is when people talk about the debt problem, there is a ratio. You're talking about the amount of debt divided by GDP growth. Now, debt we know went up in dollar terms. But if this stimulus, which it was intended to provide, results in GDP also growing up, when the denominator goes up, that ratio could well decline. And so there is a more optimistic possibility that says this debt that we put in place, that we are so worried about, will actually produce growth this time around. And just on its own, that will bring the debt burden down. Because GDP will grow at a fast rate of 3, 4, or 5%. And interest, the debt burden, we know interest rates are low. So the debt will grow at a smaller rate because nominal interest rates are way below nominal GDP rates. So what am I saying with that really long answer? We are the world's leading economy. We have the world's leading currency. It is the reserve currency of the world. Our assets that are dollar denominated have really strong economic fundamentals. So I don't think our debt situation is going to cause problems for the stock market, US dollar denominated assets like real estate, or the dollar.
Thank you. Really good insight. I hear a lot of good things about your firm. So I would like that we can also give people a little bit of insight that they learn from your strategy. And I am amazed that you take a holistic approach to every family office. You look not only on the investment, you just try to get the better value down and to basically keep it really diversified. Can you speak about the diversification aspect, how you address it in your firm, for your family offices? And later on, I will also follow up how you address time horizons from investment from the family office.
Of course. And I'm happy to describe the key tenets of our philosophy, our process, not so much that it pertains to our firm, but really the benefits of that approach for investing, especially for those with a long horizon. And my hope is through this, our audience might extract some timeless ideas that will stand them in good stead. So I'm going to try and make this informational and educational at the same time. So how do you build the best, most robust portfolio? If you have a certain amount of net worth, but you're focused only on a small portion of your investable assets. And we deal in the ultra high net worth space. So let's assume the net worth is 50 million and the investable assets are 10 million. To think of the 10 million in isolation, Carl, it may be an optimal solution for that portion of the portfolio, but it could well be suboptimal for the entire balance sheet. And I'll explain to you why. So we adopt the total balance sheet approach, even though we are not managing the rest of the assets, because that portion of your wealth could well include an operating business. You're running a business, it's privately owned, it's illiquid, but it's a business endeavor which has economic risk associated with it. If you're in the construction business, you have plenty of real estate exposure, you're vulnerable to the next recession, and rising interest rates pose a certain risk. It is incumbent for this family, for this individual, to make sure that that original $10 million of investable assets takes into account what's happening in the remaining portion of the balance sheet and invests it in such a way that not only are the risks not doubled up, not only are they neutral, but ideally you may want this customized portfolio to actually reduce the risk that is elsewhere. So pursue high returns, but look for low or negative correlations. So when those other risks perk up, there is something in the portfolio that will go up when other things are going down. So that's what Whittier, my firm, does. We build holistic, customized portfolios. The holistic dimension goes beyond all of the investment asset classes. We do stocks, bonds, private equity, direct lending, real estate, but we focus on every aspect. We provide fiduciary services, operate as a trust officer, take care of philanthropy needs, and deliver a whole range of family office services. So it really is an integrated one-stop shopping platform for those who have accumulated wealth.
I have so many questions. I just have to check the time. We have 6 minutes left.
Okay.
Okay, sorry.
No worries.
My interest is how, by analyzing the client, how you go forward to analyzing. I mean, you look at their firm. So is there a direct exchange? Do you use AI or do you use manpower? So to get everything out from the client for the information which you need for the diversification, because sometimes you probably don't know the firm and the firm is privately held, so not so much information. There are some subsidiaries or something which you don't know. So is there a long interview process when a client comes in? Do you work, do you place people in the firm which work with the client daily together? How this process functions?
Carl, it's pretty comprehensive. Sales cycles or getting to know your prospective client takes a long time. Their due diligence in whether you are the right manager for them takes equally long. And through that long process, we do everything we can to understand their unique situations, their unique circumstances, to the extent that they're comfortable sharing it. Once a fit is established, we will dedicate a really comprehensive team. I'm an investment person, so I serve as chief investment officer. I'm portfolio manager on a few relationships. I get supported by an analyst. On the non-investment side, we have a client advisor, an associate who helps him or her. So here is this team of 4 or 5 people, along with the resources of the whole firm. And Carl, I would be remiss if I didn't mention one really kind of remarkable attribute of how we approach this problem. We have 500 clients and the firm has 200 employees. So this ratio that about 2.5 clients only get served by each employee is just unheard of in our business. But what it allows us to do is really give them singular, dedicated unwavering attention, and it allows us to know a lot about them. So we know about their family dynamics, their risk preferences, and that's what allows us eventually to build those diversified portfolios, provide creative solutions for their unique needs, and we build a relationship that is so strong that it just lasts not for a few years, but for several decades, and in our case, several generations.
You also told me your firm doesn't shy away to invest for your clients in private equity. Could you describe the process, how you invest in private equity? Do you have your own funds where you invest in private equity? Do you use special vehicles? And please, how is this approach?
Absolutely. So we have a dedicated investment team of about 30 professionals. That's 30. These are your portfolio managers, your analysts, your traders. We recognize full well that as well-resourced as we think we are, we really can't do the appropriate due diligence in every niche or specialized asset class. So the beauty of our value proposition is that a client at Whittier not only gets our best thinking, we also reach out and partner with external managers. So we do the due diligence. So we go to the best of breed managers in private equity, private debt, infrastructure, venture capital. We have an internal real estate capability. So that's something we do in-house. And so we have this unique, for lack of a better word, I'll call it a hybrid platform and architecture. We do US stocks, bonds, public market investing in-house, and go outside for external managers in private markets. And there are processes, it's the usual pillars of due diligence: philosophy, process, people, and performance of the people that we are considering. Probably in that order, performance comes at the end. We really want to make sure that the approach, the process, and the philosophy of that manager dovetails with the long investment horizon of our clients. Their focus on downside risk management. We're looking for asymmetrical return opportunities, more upside, less downside, prudence, conservative. We're not trying to hit the ball out of the park, to use a US baseball analogy. So that's how we cobble together the best possible portfolio, as broad as it can be, as diversified, and yet customized to their full balance sheet.
Thank you. We are out of time, but I know a lot of people from the crypto industry listening from the Zoom. So are you recommending, or are your clients holding also crypto assets? Are you investing in crypto assets currently over your firm?
So I'm going to give you an honest and direct answer, which may not be the most popular one for our audience. So the answer to your question, much like a good politician would say, is both yes and no. We serve as a trustee and therefore a fiduciary in several accounts where the investment decision is exclusively ours. In other cases, we're simply an agent, and the client does have a say in how they want their assets directed. Should they have a strong preference or leaning for crypto, we will facilitate that. Where we have to originate the investment decision, so far we have stayed away from recommending or embracing crypto in a large way as part of asset allocation. Quite frankly, we have struggled to think of this as an asset class. An asset class produces a return stream. With stocks, it's through the ownership in a productive enterprise that generates cash flows. If you think of this strictly as a currency, one of the hallmarks of fiat currency, if I reached in my pocket and pulled out a $20 bill, I know it's a stable source of value. It may not buy as much a year from now, but I know it's going to be worth exactly $20. a number of these attributes are missing from cryptocurrency at the moment. And that's why we are taking a wait and see approach before we think that it is a legitimate asset class and can serve a role in broad diversification.
Thank you very much.